What's up everybody, I'm Jaspreet Singh and I have the newest jobs report that just came out, and what it says is that unemployment is going up a little bit. It says that unemployment claims went up by 4,000, which isn't a huge amount, but the big thing that it says is that another report showed that companies announced 32,500 layoffs in the month of June 2022, which is a 57% jump from a month ago, and it doesn't look like this layoff number is slowing down. In fact, what it says is that these layoffs are actually increasing. The reason why I'm bringing this up because a jobs report typically is just looking at the unemployment numbers, but this report that CNBC put together comparing the jobs data and the unemployment numbers did an interesting analysis where not just talked about the jobs report, but what might be coming when it comes to jobs, because it's also looking at layoffs now, which the jobs report doesn't look at directly. And what it says is that layoff announcements have soared in the second quarter of 2022, which is April, May, and June. Not a big surprise because we saw it happen. And this is after an extremely low level of layoffs and job cuts in the first 3 months of the year. It says from January through June of 2022, we saw a total of 130,211 job cuts, which is actually less than what we saw in the first half of 2021. However, the interesting part is the second quarter of 2022, which is April, May, and June. This is the highest amount of job cuts that we've seen since the first quarter of 2021, which was back when we were still in the pandemic, and we're just now starting to see the job cuts. The job cuts really started in May, they accelerated in June, and it looks like they're going to continue to get worse. The reason why companies are cutting jobs, they're doing hiring freezes, and they're rescinding the job offers is because of QT. Now I know you are a QT, but the QT that I'm talking about is quantitative tightening, which means that the Federal Reserve Bank is now trying to remove money from our economic system, because in 2020 and 2021, they printed a whole bunch of money, they injected our economy with all this dollars, and now it's causing this inflation problem that we're facing. So to fight inflation, they want to do the opposite of what they did in 2020 and 2021. So they want to pull money out of the economy, and when they pull money out of the economy through this quantitative tightening, through this QT, is causing businesses to hurt. One way that the Fed does QT is by increasing interest rates, because this makes less people interested in borrowing money. It makes corporations less interested in borrowing money. So now when you increase interest rates, what happens? Well, getting a mortgage all of a sudden becomes a whole lot more expensive. That's why mortgage rates are double now where they were in the beginning of 2022. So less people are interested in going out and buying a home, because buying a home is so much more expensive. Not just because home prices have gone up, but because your mortgage costs have skyrocketed in the last 6 months and in the last 12 months. So when less people are going out and buying a home, that means real estate agents are making less commissions because they're selling less homes. That means mortgage bankers are making less commissions because they're doing less deals. That means bankers are making less money because they're just closing less home sales. That means title companies are making less money. That means contractors are making less money. So the real estate market directly gets hit when you increase interest rates, because less people are buying homes, less people are doing real estate transactions, and that affects the real estate market. But this also indirectly affects a whole bunch of tech companies, a whole bunch of startup companies, because when you're a tech company and a startup company, you're looking for outside capital to grow as big as possible, as fast as possible, because if you keep a profit, if you make a profit, well then you have dead cash in the bank that's not doing anything. Because if you have a savings as a business, then you have cash in the bank that could have been used to help grow your company faster, to hire more employees, to invest in more innovation. So when you're a startup company, you don't want to have this profit, at least if you're getting money from a venture capital firm, or you're trying to grow as big as possible, as fast as possible. And so now, when you're in a situation where you've been relying on outside money from an investor, from a venture capital firm, or from banks, well, now you need more money in order to continue your operations, in order to get bigger. But investors are looking at you and saying, we're not as interested in investing in you because we have to borrow money at a higher rate. So we need a better return from you. And if you're borrowing money from a bank, you're going to pay higher interest rates to continue funding your operations at your business. So now all of a sudden, you as a company are saying, oh man, we need to make more money in order to stay in business. How can you make more money? How can you make more profits? Well, you got to increase your revenue or you have to cut your costs. That's how you increase your profits. And it's tough to increase your revenue when you are in a slowing economy like the one that we're in right now, where the economy is slowing down, people don't have money to spend. So it's tough to increase revenue, which means the next best thing is to cut your costs. And the most accessible and easiest way to cut your costs is just to lay people off. This is why we've been seeing layoffs across the banking industry, across the mortgage industry. It's why we've been seeing layoffs across the tech sector, across the startup sector, because all these companies have been relying on the low interest rates in order to grow, in order to boom, in order to thrive for the last couple of years. But now the Fed is doing the opposite. They're trying to pull this cash out through the higher interest rates. The second way that the Fed does QT is by selling off their balance sheet, BS, which is kind of a funny acronym for this. Now, if you do want to learn more about what's going on with interest rates and quantitative tightening and the Fed and the economy, you should subscribe to Market Briefs. It is a completely free financial newsletter that I created where my team breaks down the top finance news from inflation to the stock market to real estate to crypto to all things global economy. It's a fun, easy to read and witty newsletter that you can read in less than 5 minutes every morning, and I promise you, you're going to look forward to reading Market Briefs every morning, and it's completely free. So if you want to join Market Briefs and stay up to date on what's happening in the financial news, I'll put the link to how you can join for free down in the description below. Now, going back to the balance sheet. When the government spends money it doesn't have, it has to cover this cost somehow. Either they can raise your taxes, which is going to make a lot of people upset, or they can cut your benefits, they can cut your social security, they can cut your welfare, but that's going to make people upset. Or the third option, because somebody always has to pay the price when the government has to spend money, well, the third option is they can print this money through the help of the Federal Reserve Bank. So if the government spends money they don't have, well, then the Fed has to cover this cost. And the way that they do that is the Fed loans money to the government and they build up something called their balance sheet. Well, up until May, June of 2022, this balance sheet grew to around $9 trillion, meaning the Fed printed $9 trillion and spent $9 trillion that they did not have. Now, inflation happens when you print money without producing more wealth. And so now to fight this inflation problem, the Fed is working to sell off this balance sheet. And when they sell off this balance sheet, they need private market investors, people like you, people like me, regular people to buy up these assets. Now, if you just think about supply and demand, when you have more supply than demand, that pushes the price of something down. If you have a whole bunch of people selling toilet paper, but nobody wants to buy toilet paper, then the price of toilet paper is pretty cheap. But when you're in a situation where you have no toilet paper, but everybody wants toilet paper, now all of a sudden toilet paper becomes very valuable and very expensive. And so now what's happening is the Fed is selling off some of these assets into the public market, which is increasing the supply of these assets like bonds in the public market. And that, in theory, should cause the price of some assets to come down. And so as the price of assets come down, well, then that can cause the price of things like the stock market to come down. When the stock market comes down, that means company valuations come down. And now companies are saying, oh, we thought we were worth $100 billion. Now we're only worth $50 billion because of valuations coming down. So we need to now cut our costs because we can't support our operations at a $50 billion valuation because we still need to raise money from outside places, and banks are saying we're not going to loan you any more money because you have way too much debt, you have way too many expenses as a $50 billion company. So this quantitative tightening of selling off the balance sheet causes asset prices to go down, especially paper asset prices, things like stocks, and as those prices go down, that causes valuations of companies to go down, and as valuations of companies go down, it becomes more difficult for them to get more money, which makes it more difficult for them to grow faster, which makes it difficult for them to stay in some operations, which means that they may have to cut some people, which means layoffs. So all these things, the quantitative tightening, lead to now more job cuts. It leads to economic slowdown. It leads to layoffs because this is a part of now trying to fight inflation. Fighting inflation literally means pulling money out. It means deflating the bubble. It means getting rid of all the bubble companies that emerged. And so this is the situation that we're facing. And so if you are at a company that isn't financially sound, that is considering doing job cuts, then you want to be aware of what's happening because the Federal Reserve Bank has said that they want to continue raising interest rates, meaning they want to continue doing QT. in order to fight the inflation problem. And if they stay true on their fight to bring inflation down, well, then you can bet that that's going to contribute to more layoffs, more job cuts, and more companies going under, because that's the way that you can get rid of this bubble economy, because you have to let some of the toxic assets go down. You have to let them fail. And this is painful because it causes job cuts. It causes layoffs. It causes some companies to go under, but that's the only way that you can bring inflation down, and it's not as bad as the alternative. Because if the Fed says, okay, you know what, forget about inflation, we're just going to inflate more. We're going to cut interest rates, we're going to do more quantitative easing, we're going to do more money printing. Well, yeah, you'll create a bigger bubble, you'll create more boom, you'll kick the can down the road even more, but that makes the bubble even bigger, meaning that next time the bubble crashes, it's going to be an even more painful crash. So these are the things that you want to be aware of. I talk about what's going on with market briefs all the time. My team does a great job at breaking it down. So if you haven't subscribed yet, make sure you do that. But this is where now you want to be aware of what's happening. That way you can capitalize on opportunities, because like I've been saying in many of my videos now, more millionaires are created during market crashes and recessions than any other time, because when you see this type of volatility, when you see these types of recessions, when you see these types of market crashes, you see the prices of bad assets go down, sometimes go to zero, but you also see the prices of good assets, good companies, good real estate, good investments go down as well, and that's where you want to come in and buy these good investments at a discounted price. If you enjoyed this video and you want to see my step-by-step guide on how you can become a millionaire during a recession, I made a video covering this, and you can watch this video by clicking that button right over there. Thank you for watching, and as always, keep hustling. It ultimately comes down to one thing: buying good assets at a discounted price. Because when you have these types of market crashes and recessions,